Good afternoon, everyone. My name is Katie Bruno, and I am a financial advisor and financial planner with Maureen Quinn Wealth Partners. We are an independent firm of Raymond James. And today I am joined by Rachel Pierce with Benchmark Mortgage. Rachel is a home loan strategist and a mortgage lender. And I wanted to have her on a call today to answer a lot of questions that I've been getting about the housing market, people who are looking to buy a house and struggling their way through it, and also those who might be interested in refinancing but are concerned about rising rates. Welcome, Rachel.
Thank you for having me, Katie. I appreciate it.
So we know that navigating a hot real estate market is not an easy task right now. Prices are up, inventory is extremely low, and mortgage rates are rising. What advice do you have for someone who is looking to position themselves to find a house right now?
Yeah, no, 100%. You're accurate on that. This market is definitely crazy, something we haven't ever seen really ever, to be honest with you. There's a lot of things that I kind of talk to my clients about that are different from what we were talking about even pre-COVID. So some of those things are just ways that we can strategize to help them win their offer, right? So the biggest one is we're really kind of looking at, hey, cash, right? So the old cash is king is really a valid statement, especially in this type of market. Since it is a seller's market, the seller really gets to just say, hey, this is what I want for the house, and I'm going to take the highest and best offer. And that's really true these days. So really, we're asking them, hey, do you have any, family members that would be willing to gift you money? Do you have any family members that are willing to use cash to purchase the home so that you can either refinance it in 6 months by adding your name to title, or even you can purchase it from them immediately. But this allows you to pay cash close sooner, which is obviously a bigger benefit in the seller's eyes. So that's the biggest conversation that we have with people now. But, there's some other things that we kind of go into, which is, maybe they're able to just write an appraisal gap guarantee in the event that the appraisal comes in low. Because remember, if you don't already know, appraisals are based on, a depiction of what happened in the last 6 months versus what's actually happening right now. So sometimes there may be a gap in the appraisal. It doesn't mean your house isn't going to be worth more. Maybe some things like paying a higher deposit for earnest money, which means, you could be subject to actually losing that if, you don't meet one of the contingencies on the contract. Waiving home inspections is really common right now. Writing a seller a letter explaining to them why it's important for you to buy a home, maybe doing a rent back. Also, maybe just waiving the finance contingency. These are all calculated risks that you can think about when you're making an offer in this type of market.
Great. I know we were having a conversation a few weeks ago where you told me that there were only 100 houses on average in the Omaha market per day. And compared to a year ago, it was something like 700. And then 2 years ago, 1,400. So we know that there is not that many houses available on the market, and that people are having to come to the table with more cash to be competitive and get in a house. So what about for first-time home buyers, people who may not have a large amount of cash, maybe they're just starting but don't want to throw money away at rent? What strategies or loan programs are available for first-time home buyers?
Yeah, sure. No, that's a good one. There's actually a really great program in Nebraska, and there is one in Iowa too. IFA is in Iowa, and then NIFA is in Nebraska, which is the state bond program. Really, those programs are designed for people to get into homes at a lower interest rate, maybe get a discount on their mortgage insurance, and then they do offer a down payment assistance program. And in that down payment assistance program, you have to meet their minimum requirements, of course, to qualify for either of those, but you can borrow money on a second mortgage at a really low interest rate. It's 1% over a 10-year period and pay that back. So that can include your down payment money, maybe your closing costs, and then maybe some money to fund your escrow account. So really great program. The one in Iowa is actually a grant. They will give you $2,500 of grant money to buy the home, or you can actually use a higher grant program at 5,000, but then you have to repay that if you ever sell the house. So both of the programs are really fantastic, and they're out there to really help you maximize that out of pocket cost.
Okay, great. And a question that I get asked a lot is, what if you're going to buy a property joint and one of you is a first time borrower and the other isn't? Can you still take out a first time home borrower loan?
That is a really great question. So with their particular program in Iowa, you do not have to be a first-time home buyer. With the program in Nebraska, you do. There are some caveats to if you have somebody who lives in the household, because really what they're doing is looking at the household income limits to make sure that you qualify for that. But there is a great program with conventional financing that will still allow you to do 3% down as a first-time home buyer, and you don't have to be both of you don't have to be first-time home buyers. You can do 3% down, but you're going to get a higher mortgage insurance premium if you do that option. So yeah, that's a great option.
That's great. So speaking of first-time home buyers and home buying in general, how does someone know how much of a house they can afford?
Yeah, no, that's a really great question. Lenders are different across the board and there's lots of different scenarios and variations when it comes to qualification, but in a general sense, your debt to income ratio shouldn't really be much higher than 45% of your gross income. So monthly income, I should say. And so that would include all of your debts, housing, installment loans, student loans, anything like that. So what I would tell you though is the golden rule is, we want to keep you probably close to like 30%, 30 to 32% of your max monthly gross income to cover your housing, any association fees, real estate taxes, homeowners insurance. That's what we would typically say is where you want to be. At the end of the day, I think it's really important to know that what you qualify for and what you are comfortable with are always two different things. The truth is, someone will come to me and say, hey, I want my payment at this, but then they only want to spend XYZ dollars, right? So those don't always jive. And so we really want to hit home, before you actually hit the streets and get out there with a real estate agent, get a real good, realistic budget going on what you think is affordable for your own budget.
Right. And there are ways that buyers can look up costs of utilities and things for a house they want to purchase, right?
Sure, absolutely. If you have a specific address, and I believe you might be able to even get in touch with the utility companies and ask for an estimation. And of course, you can get on budget plans and things like that make it a little bit more affordable. And they will use what the previous owner you had as an average to give you an estimation of where that is. But ultimately, it really kind of depends, right? Are you an all electric house? Are you gas and electric? I mean, there's lots of variations there, but yeah, there's some good information that you can get to if you needed to really get that dialed in 100%.
Right. And how about people who are trying to get approved for a home, but maybe have bad credit? Is there things that they can start doing now to get to a place where they could compete in a market like we have going on?
Yeah, 100%. I would tell you that obviously it's important to get connected with somebody you trust, right? Who can kind of walk you through that path. Someone who's going to take the time and really explain to you the things that you can do. And if you're serious about buying a house, you get connected with someone that really is good at that. They can really go through the pros and cons and what you should do first. And maybe credit repair is an option for you, which is where basically a credit repair company would go out there and dispute trade lines that are out on your credit. And either get them removed because maybe the creditor isn't following Fair Credit Reporting, Act as far as the guidelines there. Or maybe there's some old things that you paid off and they don't reflect, or, there's lots of incorrect reporting on our credit reports every single day, and people just don't realize it because we don't all take the time to do that, right? It could be just as simple as paying down some debt, because ultimately, you want to keep your revolving debt at 30% or lower as far as what you can, lend on that, or what in regards to lending and what's spent on it. So, there's a lot of different variables that go into that can get you in a position. Now, in our market that we're in now, I would highly recommend that you have a conventional loan approval versus, a government loan, where those are great programs, but they're just harder to get accepted in this market, mostly because, the property has to be in pristine condition, which in some cases that won't really matter, but a seller would be afraid that maybe they have some repairs to be making on the property. And they unfortunately sometimes look at you when you're doing a government loan as, less qualified because of all the stereotypes that are out there about, government loans. So conventional financing is the best. And we really want to get your credit score in most cases above a 680. Sometimes you can get it under a 680 if you're putting down, let's call it 20%, or you've had some really good mortgage history in the past, things like that. But ultimately, we would try to strive to get you into a conventional loan product.
That's a good point. And I can speak from experience. When I bought a house in 2016, I went through a government program, and there was all kinds of things that they said could not be wrong with the house that the buyer had to fix. But in today's market, we're in a much different market where the seller has, 20 offers in some cases. And if you're asking for repairs and they have one that's cash or no repairs, they're more likely to give it to the one who can get it sold the quickest.
Yeah, I would agree with that.
Yeah. So I asked that question about credit to go into a conversation about refinancing. Mm-hmm. A lot of times I get clients asking me, should I refinance? Or we're going through a financial plan and I ask them, how much do you owe on your house? What rate? What's your payment? And sometimes I might recommend they talk to somebody about refinancing just because I think they can get a better rate. And sometimes I'll recommend it because maybe they have higher interest debt that I'd like them to consolidate into a mortgage. So can you talk a little bit about when does it make sense to refinance?
Sure.
And does it make sense now that rates have gone up over the past 6 months?
Yeah, sure. No, that's a great question. I would tell you what's really important here is it really just depends on what your goal is, right? If you maybe are trying to shorten your term because you're going to be retiring soon and you want to get that debt paid off faster, and rates are better on a shorter term, or you are really just trying to lower your payment, maybe you need to stretch it back into a 30 because your situation has changed, right? Also, like you mentioned, paying off high credit cards, installment loans, student loans, making repairs to your home, renovations, things like that, buying a car for your kid. I mean, at the end of the day, the equity in your home is yours, right? You do get nicked in rate if you're going to take some equity out, but it's not terrible. And again, that's all driven based on credit scores and things like that. But ultimately, it just really will depend on your situation and what you're looking to do there. As far as rates go, I mean, let's be honest. Even though, and I keep saying this, right? I've been in the business for, 13 years here. And I haven't really ever seen a rate over, let's call it 5.5% in that time frame. Rates are historically low. Let's be real here. I mean, I was looking and did some research right before I got on this call. And in 1983, which I'm not going to date myself, but I definitely wasn't old enough to buy a house. Interest rates were between 15 and 18% to buy a house. So, a lot has changed, and we will constantly see the cyclical repeat of rates going up and rates going down and where they are and this, that, and the other. But ultimately, it's still a great time to buy. It's still a great time to refinance, especially if your situation calls for it. And ultimately, I like to see somebody save 1% as a golden rule if they're going to refinance. Now, if you're taking cash out and shortening or lengthening a term, those are different scenarios, but ultimately 1%. But if it's on a big loan amount, let's call it over 350, I mean, even 0.5% can make a huge impact in decreasing that interest over time and even on that monthly payment.
That's a good point. So, and for someone to reach out to see what a rate would be and to see if it makes sense to refinance, is that something you could do a comparison for them and say, okay, here's your current loan payoff, and if we refinance, this is what it looks like? And maybe, I know a lot of people are concerned about closing costs and having to repay closing costs. Mm-hmm. I think it really comes down to how long are you going to stay in the home to when it's going to catch up to whatever the closing cost was that was added to the loan.
100%. We would look at, when's your break even point on this. You can even, if rates are even in a good position, you could even raise your rate just a little bit and have your lender pay your costs so that it's a no cost loan if you needed to, depending on where your rates are. There's lots of different scenarios with that. But yes, 100%. We can put together numbers and look at some different options. It's not really, hey, there's only one path, there's lots of different lanes that you can be in. And really our goal, I think, even with you, Katie, we're planners, we want to really help you and make sure that your short and your long-term goals are, matched up with what's important to you and what's going to fit your scenario. So I think that's the key there.
Great. And what is the best way for someone to get a hold of you?
Yeah, I do have a website that you can look me up, benchmark at benchmark.us, Rachel Pierce, or you could email me at rachel.pierce@benchmark.us, or my office number is 402-933-1527.
Great. And I will put that in the chat for everyone. Thank you, Rachel, for taking the time to help us and inform us on what's going on in the interest rates and in the housing environment.
Yes, thank you so much for the opportunity, Katie.